Welcome to the Citrin Cooperman's Corner Chat. I'm Peter Katz of Westfair Communications, publisher of the Westchester County Business Journal, Fairfield County Business Journal, WAG Magazine, and digital newsletters to keep you informed. And on this edition, we're joined by two of Citrin Cooperman's experts who are going to provide you with some of the vital and valuable information you're going to need in preparing your business for possible sale in these uncertain times. And even if selling isn't on your plate right now, you're sure to take away some significant insights into the finer points of business finance and learn just how important it is to have real pros you can rely upon. And first, let's say hello to Eugene Ruvere, a partner in Citrin Cooperman's White Plains office. Eugene's central area of expertise is in sales and state, local taxes, income taxes, property taxes, employment taxes. How many other taxes are there, Eugene? Welcome.
Thanks for having me here.
And Marilyn Garcia is a principal with Citrin Cooperman's Transaction Advisory Services practice. Marilyn provides due diligence services when you're preparing for a sale. And welcome, Marilyn.
Thank you for having me, Peter.
And Marilyn, let's plunge right in. We are in unusual times now, what with the COVID-19 pandemic. And how has that impacted what you have to do on a day-to-day basis in helping business leaders prepare for possible sale of the businesses?
Yeah, thank you, Peter. We are in a pandemic, but the sell-side due diligence preparation is initiated in the same exact way. We start by allowing the owner of the business to focus on the operations specifically, especially in this time. And our team just comes in and dives into the financial statements, financial information with an emphasis on EBITDA. With COVID impact, we do help the seller tell their story. We help the seller adjust their earnings by adding back non-recurring expenses, personal expenses, anything that they deem temporary and not recurring to their business moving forward. So COVID-19 has had a large impact in that. There are some companies that are able to identify, expenses or revenue streams that are temporary due to the pandemic situation we're in today. Now, there's still deals being made, but lenders and equity investors are taking their time through the due diligence process. So it's taking longer. They're asking more questions. They want to understand if you do have COVID adjustments to get to your adjusted earnings number, what are they? Are they quantifiable? So having us engaged a independent accounting firm, we're able to help you tell your story through the financial statements. We're able to quantify those expenses or the revenue streams that are temporary. We're able to put your thought process and the operations of the business into financial models to help investors understand what's happening to your business. The investors right now, they want to know more than what EBITDA is today. They want to understand what management has been doing through the crisis, how they've been managing cash flow, how they've just been managing their business in general. So part of our due diligence today has to do with a lot to do with telling your story. It's not just the numbers anymore. If your numbers aren't today, don't reflect what they will be in the future. So we're on board, quantify, normalize EBITDA calculation, helping you identify adjustments to your earnings, adjustments to working capital, understanding the impact to your business and portraying that to an investor. So it's just taking a little more time because there's much more due diligence involved, but we're here to help, and having a sell-side due diligence just gets you ahead of the process, ahead of the game, and it alleviates a lot from your management team through the sale process.
And Eugene, how has the tax situation been affected by COVID? I know there was this proposal for deferring some of the withholding taxes. You have some companies getting loans which are going to be forgiven, and the questions as to whether that would become taxable. Just how has the pandemic affected your analysis of what a business's situation is with regard to all the various taxes?
Sure, Peter. So things have changed a lot. And from a state and local tax perspective, there is a ton going on right now. So for businesses that are or owners of businesses that are contemplating selling their business, we're really zooming in on those issues related to COVID. And even before COVID happened, state taxes were an important part of the due diligence process. But right now, because things are evolving where people are doing work in different states than they had historically, that can create nexus issues that thereby create exposures for businesses. In addition, because states are going to have significant budget issues related to COVID, we expect the enforcement of the tax laws to be ratcheted up quite a bit. So when a business is contemplating selling itself, we really have to think through what state tax exposures there are out there, not only historically before COVID occurred, but those that are evolving right now because of the different geographic footprints that a company may have.
Well, suppose we're in a situation where I have a business and I'm based in New York. I'm a New York State corporation. And yet, because of COVID, my employees are working in New Jersey. They're working in Connecticut, maybe as far away as Rhode Island or Massachusetts. In fact, when you're working remotely, it could be anywhere in the world these days,
Sure.
with the internet. How does that factor into what you have to do to prepare a business? Number one, to be sure they're all in compliance with whatever the regulations are, and number two, when you're setting up a sales situation.
Yeah, that's a good question, Peter, because the guidance out there is really evolving on this issue. There's been about 15 states so far that have provided guidance, and it's been pretty gracious guidance where they've said you can ignore the presence of an employee who's temporarily working in a state for nexus purposes. So, nexus is the connection to the state that allows the state to impose a corporate income tax or require a business to collect sales tax. So those states have been pretty gracious and said, you know what, during the COVID period, don't worry about it. Other states, though, haven't given out any guidance. And that leaves us in a lurch because we're not sure whether that means they haven't gotten to issuing the guidance that we can ignore this situation, or that the rules are as normal and the physical presence of an employee in a state can trigger those tax filing responsibilities. So it's a tough thing to track right now, but for a business that is contemplating a sale, they really have to be cognizant of this issue because there's the potential that it's creating exposures and a buyer is going to zoom in on this type of stuff. So we have to be have a heightened awareness of it, think about what possible exposures might be created, and talk through those issues with our clients.
And Marilyn, how has the remote work situation affected what you do, your interfacing with clients, your ability to look at the numbers, to drill down on spreadsheets and all of the record keeping when you have to work remotely or everyone else in the company you're doing due diligence on is working remotely? What are the mechanics that you've had to deal with in order to perform the functions that you would perform as Citrin Cooperman helps people get their business ready for possible sale?
Yeah, sure. Well, the majority of our business pre-COVID was being done virtually. For instance, we always host a data site where we make our requests and have the businesses upload the data we need, the data information we need. In person, we haven't had any in-person meetings, which we usually do to kick off the engagement, to have our management meetings in person. It's always a lot more efficient to speak and tour the facilities and really get to know the business. But that's something that we have been able to do virtually as well. My business, the companies that I assist are not all necessarily local to me. So I don't always travel to them either. So We've always been able to communicate on conference calls, on virtual meetings just like this. So it hasn't changed much. It might be a little difficult for a company who doesn't have information electronically available, say contracts, and they just have hard copies. Then it's just a matter of them having to, convert that into electronic copies and have that available for us. But as I mentioned before, a lot of our work is done in our offices. We drill into the financial statements. Our report is done by us without, the management team. So it hasn't affected us in any way. And again, it's just affected companies that are not used to that. But it's okay since we've been part of that process before. It's just a matter of helping them, get comfortable with the data site, helping them obtain information electronically. So it hasn't been a big deal. It hasn't been a disruption at all.
And Eugene, over to you. And I don't know whether you can do this or not without violating anything ethical or any confidentiality requirements. But are there particular situations that you've been running into where there have been issues regarding tax compliance with your clients as a result of some of the confusion that you mentioned just a few minutes ago regarding the COVID situation?
Yeah, certainly, Peter. And we can speak generally to that. So there are situations where we've seen, and you touched on it before a little bit, Peter, where there's cross-border issues where employees who have historically worked in, say, a New York office are now working all over the country. And it could be as far-flung as California and Washington State and so on, because people are pretty mobile. And in the COVID situation, we have a lot of clients who have employees who are just trying to find a safe spot. So that, again, as I touched on before, the presence in a state for an employee can trigger nexus for state tax purposes. And often we've seen that there can be a client concentration in a state where an employee is now working. And that raises all sorts of issues from a corporate income tax perspective, from a sales tax collection perspective. If the company is selling taxable goods or services into that state, it can be a real game changer. So being aware of the possibility that the presence of an employee in a new state can have an impact on the tax liabilities of the company is critical. Having those conversations with your advisors is so important. And as you step into a situation where you may sell your business, just having that foresight is so important, because we know that there are going to be people on the buy side who have advisors who are going to be asking these questions. And if we hesitate and say, you know what, we've never really thought about that part, and they'll jump on that, and it can create an impact on the potential sale price of the business.
In general, how significant are tax issues when you're preparing a business for sale? Is it, we've heard that people really should not be concerned about taxes. You should do whatever you're going to do and not worry about taxes. Now, is that valid for a situation where someone wants to prepare their business for sale at the best possible price?
I would say no, Peter. I mean, we really do see taxes as a significant piece of the business sale process. And over, there can be significant exposures. I'm dealing with a transaction right now where there's multiple $1 million of state tax exposures. And it's just something that's out there all the time. It's something that should not be ignored. From a business operations perspective, the business needs to do what it needs to do to generate profits. There's no way around that part, and we're not going to say you shouldn't do something because there may be a tax impact to it. But if we're at least aware of what the triggers are and the considerations that go along with making changes to your business operations, then we can get in front of it, and we can address those issues without creating exposures and remaining compliant.
And Marilyn, as you're doing due diligence in a sales situation, is tax compliance something that's important? Is that something considered by both sides, or is that a fairly minor element when you're looking at a manufacturer, for example, or you want to see how they do in terms of the gross profit they do on a particular product line. Where does the tax situation fit in when you're doing due diligence?
Thank you. When performing due diligence, depending on the industry, as you mentioned, manufacturing, we always try to understand who they're selling to. We engage with our salt practice, Eugene and his team, all the time because it is very important, as you highlighted before, understanding their not only the tax compliances with every state that they're doing business in, but also understanding their employee versus contractor liabilities and compliances there as well. So it's part of our due diligence. It's not the bulk of our due diligence. It's financial due diligence, and I focus on the company's profitability and true earnings. But tax is always something that we do bring along on the sales side. Maybe not a deep dive, but just to highlight some issues that may be happening. The buy side will dig into the tax, sales tax issues as well. Within our team, we also have members that help us with tax structuring, but again, that's more of a buy side. So on the sell side, we do initiate some due diligence with Eugene's team just to have a high level understanding of any red flags that may come up during the buy side due diligence.
And how do you go about this? Do you go in, with a shopping list of items that you're looking for, based on your experience, based on Citrin Cooperman's longevity and handling these sort of transactions? How do you do the due diligence from day one?
So we speak with management at the beginning, and we understand their business, their industry. We have heavy industry experience, so our experience lends a lot to how we proceed in the process. We do have a scope of items. A lot of our due diligence calculations, again, normalized EBITDA calculation, working capital calculations, understanding the margins. That's going to be across the board, all industries. Anything that's industry specific, we have the experience on. If we don't have experience, we do have it in-house with any of our other partners that join our team. So our report more or less will be structured the same. And depending on your industry, we'll focus on certain details, certain customers, certain deal structure issues, whether it's an LLC or a corporation. So it does change, but we do have a templated scope that we change and alter depending on the business, how in-depth the business is, the business structure, and again, the industry.
And as you're doing this, do you ever find huge surprises? Say a seller who is trying to hide something, for example. Say books that just don't look right, for example, something like that.
Yeah, no, we do. Again, nothing project related, but it's very common for lower middle market companies. And when I say lower middle market companies, it's companies that have revenue less than 250 million. So it's very common for these family businesses to have family members that aren't necessarily employees on the payroll, just having owners having the discretionary expenses, some car leases in there. So we do come across that very, very often. And we always ensure them that, we're not auditing them. We're on their team. And these are the kind of things that we need to bring out forward before a buyer comes in and sees that. And when you think about earnings, EBITDA, you want to be able to extract any expenses that are not part of the business going forward. That'll only make the net income, the bottom line, look better. So we have those conversations all the time where we need everything on the table. We need to understand what expenses are here on the financial statements that should not be in here, or that would not be part of their financial statements moving forward with a different owner.
And Eugene, basically same thing for you as you and your team take a look at a business's financial situation regarding taxes and other things, perhaps. Um, do you find real problems, real issues, and what can you do when you find something to help resolve that?
Sure, Peter. Yeah, we definitely see all sorts of things. And as Marilyn said, our focus is not, we're not here to lob criticism, but we're here to rectify issues. So when we identify a problem, say from a sales tax perspective, that a company may not have been collecting sales tax in a state where they should have been for 5, 6, and 12 years, there are programs out there with the states called voluntary disclosure programs, where the states, if a business comes forward voluntarily, the state will offer certain benefits, including a limited look back period of 3 or 4 years, penalty abatement, on rare occasions, some interest relief. So these programs are very beneficial, and it gives a business an opportunity to rectify those problems that they've kind of been either looking away from or just weren't aware of.
And if we can, tell me a little bit about your background. How did you become interested in such a specialty item as taxes? Most people try to do a 1040 every year is a real catastrophe. How did you become interested in this particular subject?
So I would say most people try to do something else besides taxes as a career. So I think it's a somewhat unusual approach to a career choice. But for me, my appetite became strong for it when I got an internship out of in college, and I got taken under the wing of somebody who had been doing state taxes for over 30 years, and they really just had an intense knowledge and thirst for learning more and more about the nuances of tax law. And once you start reading the tax law and trying to apply it to companies' facts, for me, it's interesting. I know it's, talking to my wife about my career may be a different story. Not so interesting for her, although she tries to stay interested. It is something that it was right for me. Just reading through tax law, understanding the nuances, thinking about planning for our clients. And like Marilyn touched on before, there are opportunities on the buy side to think through, well, if I structure things a certain way, if I change my residency, my state tax residency before the sale, is there an opportunity to save some money here? And for me, that's pretty darn interesting.
And Marilyn, essentially the same question for you. How did you become interested in doing due diligence on business transactions such as this? And also in looking at your background, your bio, I happen to notice that you have some international experience.
I do, yes. I started my career in public accounting as an auditor. I did that for about 4 years. Then I transitioned to the firm I was with, their transaction advisory service team practice, which was a new topic. This transaction quality of earnings has, it's fairly new. It started to come up in the 2000s with private equity. And with my auditing background, it just came very natural to me to look at some of these financial statements and ask certain questions that related to M&A practices. So it was much more interesting than audit. So thankfully, I did find transaction advisory, and I started with helping buyers, specifically private equity funds, with their due diligence process, and then not too long ago, we started to help the business owners with the sell side of due diligence. So, for example, last year we did about 70 quality of earnings reports, and a third of that was for sell side due diligence. So they're very interesting, much more interesting than audit. And I personally enjoy helping business owners tell their story and helping them understand the transaction process.
And is it something that a business owner should dread? I mean, having a firm like Citrin, Cooperman, sending people in to start examining things under a microscope, is that something that people should be scared of?
No, I don't think so. Again, it's such a great tool to have, whether you're going out to sell your company today, tomorrow, next year. It's a great way for an owner to look at their business high level, understand what their true earnings are. There's many businesses that, business owners that have been working on running their business, growing their business, and they are great at what they do. But when it comes to the financial understanding of the business, or just the financial understanding of the business for a buyer to understand your business, it's not something they pay attention to much. So I don't think that the sellers I work with dread the process, because it's fairly simple. We're there, we're holding your hand, we're helping your accounting team, and it alleviates so much stress when the transaction comes to play. You're already ahead of the game. You already know what your company can be valued at. You already know what potential earnings you can generate. You can have a conversation with any seller, understand any questions they're asking, any requests. So for me, I haven't felt like any of the company owners I've worked with have dreaded the process. It's fairly, it can be lengthy. It only takes about 4 weeks, but it's a great product to have available when you're ready.
And Eugene, same for you on the tax side. What is the importance of getting the taxes straight when you get into a situation where either you want to sell in the short term, or perhaps you want to see how you can position things for a long-term sale? How important is the tax aspect?
Yeah, and Peter, from my perspective, it's critical. And for our client base who, maybe preliminarily are dreading us coming in to look through their records and to interview them on their facts, I think what comes of it is a lot more comfort in knowing where they are. So often enough, they don't know what's behind the curtain, and they've kind of shied away from really examining it. And when we get in there and sort things out, they at least have that knowledge, and we create a pathway to resolve any sort of issues that they have. And also, as your question touched on a little bit, it's an opportunity to find potential benefits. And that's not just minimizing exposures, but also structuring the business in a certain way to save tax dollars. And just if the company's contemplating an expansion, looking for tax incentives that may be out there for hiring employees or adding assets in a state. Those are all things that can come out of having conversations like this. And as a business owner, I could see that as valuable things.
Any insights or any hint or even a prediction as to where we're going to be on the COVID situation, where businesses are going to find their tax situation, their financial situation in general, once this pandemic can be treated as history rather than something we're trying to cope with? Marilyn, you want to tackle that?
When I think of the situation, we're still in COVID, so there's still a lot of unknown and a lot of questions that we don't have answers to, as far as what's going to happen to certain industries, what's going to happen to certain clients of ours. I think in the future, or definitely now and towards the end of the year, and as deals start to flow more, I think the reality of every deal structure is that there's going to be more of an earnout, meaning the risk of the business is going to lie on both the seller and the buyer. So an earnout is basically, when I say earnout, I refer to the purchase price structure where the seller will need to hit most of the purchase price at the tail end, after certain performance, after certain metrics have been met. I've been speaking with a lot of owners who are very optimistic. They know that they will get back onto pre-COVID levels. They know that they can continue to grow their business post-COVID, and that's great. But it's more of helping the buyer be comfortable with your optimism, and they're ready to make a deal, except the purchase price at the front end is not going to be what it usually was. So there's just much more of that earnout structure where the seller just needs to be much more comfortable and understand that the risk of the business growing and what they think will happen will need to be both on the buy side and sell side. So a lot of that purchase price will just be towards the tail end. And when I say tail end, deal structures vary, so it could be different. But whether it's them earning more 2 years from now, 3 years from now, 5 years from now, as we start to play out the situations.
And Eugene, same for you as we move out of COVID. Are we going to be back into a normal, complex tax situation?
I would say that the remote workforce issues are really what are prevalent in my mind as we move out of COVID. That, historically, although many companies had already evolved to having a lot of folks work remotely, a lot of businesses now are recognizing that they can operate effectively and efficiently with a remote workforce. So while they may have only had offices in 1 or 2 states previously, they're now looking at having employees across 10, 15, 20 states. And that can trigger a plethora of state tax compliance responsibilities that they just hadn't contemplated before. So I think that'll be the new normal coming out of COVID, and we're ready to help our clients with those issues.
And Eugene Ruvere and Marilyn Garcia, thanks so much for being with us. And this has been another edition of Citrin Cooperman's Corner Chats. I'm Peter Katz of Westfair Communications. Stay safe.
Join us again for the next Citrin Cooperman Corner Chats.